Welcome to The Explainer. Today, we are digging into a really powerful investment thesis about the future of AI and money. We're going to explore what happens when our digital assistants start handling their own cash. All right, let's just jump right into the deep end. What happens when AI agents start spending money? And look, this isn't just some sci-fi fantasy, right? This is the core question that is poised to completely reshape our financial world. We're talking about machines becoming active players in the economy, not just tools. So, how do we even begin to wrap our heads around this? Well, there's a framework for it, and it's called the Agentic Commerce thesis. This is a concrete way to think about a massive economic shift that, frankly, is already starting to happen. Okay, so what's the big idea here? It's actually pretty simple. The financial plumbing we all use every single day, credit cards, bank transfers, it was all built for humans. It's slow, and it's based on things like identity and trust. That system just wasn't designed for the crazy speed and scale of a machine-to-machine economy. So how does this actually translate into an investment strategy? Well, the thesis lays out three potential futures, three different worlds, really, and each one has its own unique logic, giving us three different ways to bet on how this whole thing plays out. All right, first up, let's talk about the conservative play. The thinking here is super simple. Infrastructure wins regardless. This portfolio is built to cash in on the explosive growth of AI compute and digital payments, but, and this is key, without having to bet the farm on crypto succeeding. And you know what's so compelling about this approach? It's all about stability. It's designed to win because as AIs get smarter, they're going to need way more cloud power from giants like Microsoft and Amazon. And they'll probably just default to using the payment rails we already have from Visa and MasterCard. It's basically the path of least resistance, and it's the bet that Wall Street is already comfortable with. Okay, moving on to the balanced world. And honestly, this might be the most realistic scenario of the three. The idea here is that two systems develop side by side. We humans stick with our credit cards, but AI agents, who need speed and flexibility, start using new programmable digital rails, like stablecoins. And this is where things get really interesting, because this portfolio tries to capture what the market might be missing right now, that huge, underpriced potential of crypto infrastructure. But it does it without going all in. It's a smart bet on both the old guard and the new world coexisting. And that brings us to the final portfolio, the aggressive one. This is the all-in bet, the home run swing. This is for a future where machines are doing more business than humans, and they're doing it on brand new, open financial networks. So yeah, this is your classic high-risk, high-reward play. It's a direct bet that this new programmable money is just flat out better for a machine economy. Now, the ride is going to be wild, for sure, super volatile, but the potential upside is just massive. That's what investors mean by convex or asymmetric. The potential gains are way, way bigger than the potential losses. So, you might be wondering, where does crypto actually fit into all this? What's its job in powering this new machine economy? Let's pop the hood and take a look at the engine room. Okay, so when we talk about crypto here, we're really talking about two big players, Ethereum and Solana. And the easiest way to think about them is like this. Ethereum is your digital Fort Knox. It's all about trust, security, final settlement. Solana, that's the racetrack. It's built for pure, unadulterated speed and handling tons and tons of transactions. And this is absolutely key. It's not about one winning and the other losing. A real, functioning machine economy needs both. You need a super secure place to settle high-value transactions, and you need a lightning-fast network to execute millions of tiny transactions in real time. One just doesn't work at scale without the other. Right. But none of this happens in a fantasy land. There are real-world rules and regulations, and these are like giant switches that can either greenlight this whole future or shut it down completely. So if you're watching this space, these are the triggers to keep an eye on. On the bullish side, clear rules for stablecoins, that's the holy grail. It would just open the floodgates for big money. But on the bearish side, what if regulators force AI into these closed-off proprietary systems run by big tech? Well, that could sideline crypto for a long, long time and just make the incumbents even stronger. Okay, so these portfolios look great on paper, but what happens when you throw a wrench in the gears? Let's run some stress tests and see how they actually hold up in the real world. First up, a tech wreck. Think 2022 all over again. Interest rates are soaring, growth stocks are getting crushed. What happens? Well, the aggressive portfolio gets absolutely hammered. The balanced one takes a serious punch, but the conservative one? it holds its ground pretty darn well, all things considered. Okay, stress test number 2, the regulatory hammer. Let's say regulators decide crypto is public enemy number 1. The aggressive portfolio? It's a catastrophe. We're talking an 80% loss. But here's the crazy part. Look at the conservative portfolio. It actually makes money. Why? Because its competitive moat just got a whole lot wider. Visa and MasterCard become the only players left standing. But what if the thesis is right? What if we get that agentic breakout, a massive productivity explosion powered by AI? Now you see the magic of that aggressive portfolio. The conservative one does fine, a solid 20% gain, but the aggressive one, it goes parabolic. We're talking 200% returns. That's that asymmetric upside we were talking about. So we've walked through 3 different worlds, we've stress tested them. What's the one big idea, the final mental model you should lock in after all of this? It all boils down to this. Programmable money is optional, until it isn't. Right now, for you and me, Visa works just fine. It's a choice. But for an economy of millions of AI agents firing off thousands of transactions a second, at some point, the old system just breaks. It stops being a choice. It becomes a necessity. And this table just nails it. It's the whole thesis in one spot. You've got the human world running on Visa and MasterCard. Then you have the machine world running on stablecoins. And inside that machine economy, you need Ethereum as the ultimate trust layer and Solana as the super fast execution engine. It's as simple as that. And this is why there's even an opportunity to talk about. The market is really good at pricing in slow, steady, predictable change. But this shift, this agentic commerce idea, it's not going to be slow and steady. It's going to be a step change, an explosion. That's a non-linear outcome, and the market is almost never ready for that. So let's end on this thought. The moment machines are doing more business than people, the entire crypto infrastructure gets repriced. And it's going to happen fast. So the real question isn't if that day is coming. The question is, how soon?